Okay, I think we're ready to start. Welcome everybody to our latest Global Steel Markets webinar. It's been a while since we've had one, but steel markets globally have been very active and there's been a lot going on. So we have quite a lot to cover today. I'm joined today by 4 of my colleagues from around the world. We have Berçak Altman from Turkey. We have Katya Urakova covering CIS. We have Emanuela Norsa talking about Europe and Dan Hilliard from the USA. And I'm Tomas Gutierrez. I'll be talking about Asia. Okay, we are going to start off with me on China. So to get things started, I'd like to have bring up a poll on iron ore prices. Can we have the poll up, please? Okay, so the poll is, where do you see the 62% Fe core index by the end of Q3? And you've got 4 options. So interesting, people are expecting prices roughly in the range where they are now. Only 12% of people think prices are going to increase over the next few weeks. 28% expect some decrease, 9% expect a more significant decrease, but a solid 51% think prices between $190 to $210 a ton CFR. That's it's an important judgment that people are making in the market, and it's a judgment that's being made in the market that's very complicated and confusing these days. I'm just going to bring forward my slides so that I can show you what's been going on with iron ore and steel prices so far. So this is where I'm going to kick off, and you can see we've had a pretty interesting trend over the last couple of weeks. Iron ore and this is Chinese domestic rebar obviously move more or less in unison for much of the time, but we have seen a bit of a break in the last couple of weeks, and in particular when iron ore slumped in the second half of last week, we actually saw rebar prices doing pretty well. And this week, now that iron ore has stabilized really since Monday, slightly above $200 a ton, rebar prices have actually also remained quite strong. Interestingly, not only stronger than iron ore, but also stronger than HRC in China. Rebar inventories are actually starting to tick a little bit lower in China, which is unusual for this time of year. So there's a question here, what is driving these prices in different directions? I think if you look at markets globally, there's a lot of confusion over why some prices are moving one direction, other prices are moving in the opposite direction. And there's a question over what it means both for iron ore and steel prices. And the view in China is very much that they're hoping that we're entering a period where iron ore prices are lower. There's a lot of worry at the moment about importing inflation into China. So this doesn't just cover iron ore, it covers a wide range of commodities. But iron ore is one of those kind of fairly high profile ones because of the volumes that are going into China. And there's an issue with how that's being achieved though, which is that steel mills are profitable, and when steel mills are profitable, people pay for iron ore. So there's a little bit of a conflict there. So let's take a little bit more of a look at what's going on and what the implications are. So the first thing to bear in mind is that Chinese demand isn't particularly strong right now, and in particular compared with a year earlier. So in the first half, obviously, we saw very high steel demand growth rates, but a lot of that was obviously because of the COVID crisis a year earlier. The year-on-year comparisons were always going to be very high. But what we've seen in the summer is a fairly significant drop in end user demand. This chart just shows the green bars are demand and the beige mass is crude steel production, so you can see the comparison. And you can see that Q2 there was quite strong demand, but at the end of Q2, demand came off quite significantly. In July, demand has remained fairly weak. So the strength that we're seeing in Chinese steel prices isn't really a question of strong demand. In fact, the demand slump also caused a decline in prices, which is quite visible on the previous slide as well. So what is going on? Well, sentiment's really being hit quite significantly by these moves to cut production in China. At the beginning of the year, the Ministry of Industry and Information Technology, they issued a statement saying that they wanted 2021 crude steel production to be down from 2020. It didn't really seem realistic, and especially in the first half of the year with very strong year-on-year production growth, there was really no sign of that being translated into policy. But we have seen a change over the last few weeks in terms of more and more provinces saying that there are cuts coming, more and more provinces saying that they will cap output. And there's a fairly clear implication from this. If this is really just a calculation in general terms based on what we know, there's not a lot of detail on the policy, but based on the statements, in order to achieve that 2020 crude steel output target, China would have to produce 60 million tons a year less crude steel in the second half of this year than it produced in the second half of 2020. So there's a significant tightening of the market there, and partly because there's uncertainty, there's a lot of speculation as to how tight Chinese steel markets could get. There's one interesting clue, which is something I think not many people have picked up on, which is if you look at Chinese crude steel data, it's constantly being revised. So if you look at this year's data and last year's data, it will never match up. But the revisions always follow a trend. So, and those trends normally follow policy. So when China was really trying to bump up GDP, the revisions were always higher. When China was really looking at environmental cuts and supply side reform, revisions were trending lower. From last year again, revisions were trending higher. And from May and June, we started to see that trend shift again. So when MBS starts revising its data downwards in a kind of fairly general sense in terms of both this year's data and last year's data and across provinces, it's normally a sign that there's some kind of national policy shift going on. So the implications for steel trade are obviously going to be fairly significant. You can see from this chart fairly clearly, the really strong demand at the end of 2020 left, China a net steel importer for a while. Since then, net steel exports have picked up quite significantly. But from May, obviously we've had the end of the tax rebates for most products, and a lot of speculation about new taxes coming into place. So the trend here is fairly clear that production is probably going to be lower. Demand might not really be stronger, but markets could be tighter just because of the cut in production. And exports are not going to be encouraged. So this is the moves that were made in May were effectively roughly 13% tax increases on most products. There are further export taxes expected. A lot of confusion about this so far. Everything is still very uncertain, but the talk that we're hearing is probably either a 15% or a 20% export tax on HRC, potentially tax on CRC as well. And that may come in on the 1st of August, but more likely the 1st of September as a start date for that. Having said that, there are also traders and mills who are saying it's not going to happen, that there's no need to reduce steel exports further, considering they're already cutting production. So very uncertain, but the trend is to control exports. And then for raw materials, obviously there's an implication there as well. So iron ore, there's already a trend of iron ore supply probably picking up by the end of the year. And of course, if Chinese steel production is falling, its iron ore purchasing should also decline. So a much looser iron ore market going forward. Of course, on the one hand, that does imply weaker iron ore prices. But on the other hand, if Chinese steel margins are very high, iron ore prices have never really come off as long as steel profits are high. It's always been one of the problems for the steel industry, is that whenever it's making money, the miners are always making more money than the steel makers. And nobody's been able to break that link yet. And also for scrap, scrap is also going to have limited import demand. We saw the big loosening up at the start of the year, and some expectations that scrap imports would be very, very high this year. We were not, in fact, we were quite near the bottom of most people's expectations of scrap imports for this year, but actually the market has even underperformed our expectations. H1 imports were only 330,000 tons. So although China joining the market has been significant, the volumes are actually low, and with production controls, there's no need for those to increase much either. And finally, I just want to say one more thing about Southeast Asia, because we talk a lot about China, but Asia is not just China. And Southeast Asia is one of the really important areas for steel trade because it's still the biggest sink for exports from the rest of the world. Not only from China, but from Korea, from Japan, from India. And in Southeast Asia, there's a really big problem with demand right now linked to the COVID outbreak. Everybody was looking forward to a very strong year this year. Recovery from COVID, lots of infrastructure budget. But actually, country after country has been announcing new lockdowns, new restrictions, and that's really had a big impact. And in this chart, just as an example, this is blast furnace activity levels, which we take on a weekly basis for 10 Southeast Asian blast furnaces. It's based on satellite data that we get from a third party called Tatio Earth. And you can see from that very clearly at this slide here, that once you start to get, in particular, the Malaysian and Vietnamese lockdowns from June, you see a kind of step change in blast furnace activity levels based on that satellite data. To see more of that satellite data, take a look at our weekly Southeast Asian Steel Report for those of you who are interested in that. I'm going to leave it there because we're going to be short on time. So I'll hand over now to my Turkish colleague, Berçak Altman. Thank you, Berçak. I'll leave you to take it away.
Thank you, Tom. Good afternoon from Turkey. Well, I want to start my presentation with an introduction to Turkey's steel industry as usual. Okay. In Turkey, as seen in the outputs based on different production processes, 70% of crude steel output was produced by electric arc furnaces in January-May period this year. Consequently, Turkey's steel production is still highly dependent on scrap. Scrap consumption by electric arc furnaces in Turkey stood almost at 93%, while blast furnaces' share was only 7%. On the other hand, domestic scrap share among Turkey's scrap consumption in 2020 was only 23%, with 6.7 million tons. This was down from 32.6% and 9.1 million tons in 2019, due to the negative impact of COVID-19. Over January-May this year, Turkey's scrap imports increased 32.9% on year to 10.8 million tons. With 22.4 million tons of scrap imports in 2020, Turkey keeps its position as the world's foremost steel scrap importer. Turkey has a 52 million tons of crude steel production capacity, while utilization appeared at 67% in 2020 and 74% in January-June period this year. In 2020, Turkey produced 23.2 million tons of billets and 12.6 million tons of slabs. Looking at Turkey's production versus consumption data, as seen on the table on the left, Turkey's long steel production stands well above consumption, which makes Turkey a net exporter in long steel products. In flat products, however, Turkey's production remains below consumption, and this makes Turkey a net importer of flat steel products. 2020 steel consumption was up by almost 13% to 29.4 million tons in Turkey, despite the virus. 2020 flat and long steel exports declined 5.5% to 16.6 million tons, while imports rose 4.5% to 12.5 million tons. The ratio of exports to imports in 2020 fell to 111% versus 121% in 2019 due to the increase in imports and decrease in exports. This chart shows the price trends of Turkish imported scrap, Turkish rebar export, and Turkish domestic HRC prices since the beginning of 2020. We can clearly see how steel prices soared starting from the last quarter of 2020. Global economies have partly recovered from slump in the first half of 2020, and gradual increases in manufacturing activities raised steel consumption and steel prices, as well as scrap prices since the last quarter of last year. Looking at the margins between 2015 and 2020, average margin between scrap and rebar appeared at $174 with high fluctuations, as you can see on the graph. The red line here shows the average margin, while the blue line refers to the average cost. We consider $160 as average rebar production cost from scrap, with a very rough calculation, of course. Although the margin dropped to $142 in 2020, which is the lowest since 2017, by the way, it has then recovered. The margin has hit its historical highs in May this year, with $277. Currently, it stands at $250, with scrap at $475 and rebar at $725. And this one is the scrap and HRC margin between 2016 and 2020. Average margin appeared at $229, also with fluctuations. The green line here shows the average margin. Blue line refers to the average cost. And we consider $190 as average HRC production cost from scrap. Although it has hit $141 in April 2020, it has then recovered. I'd like to pay your attention that this $141 scrap HRC margin was even lower than the lowest scrap rebar margin. It has hit its historical highs, which is $688 in June this year. Currently, it stands at $575, with scrap at $475 and HRC at $1,050. This is the result of ongoing imbalance between supply and demand in flat steel products, of course. Regarding decarbonization or European Union's green steel target, Turkey's steel industry has already lowered carbon emissions by 20% in the last 10 years, and the industry's current carbon emissions are much lower at 280 kilos per ton compared to the EU. This is given that 70% of Turkey's steel production is based on electric arc furnaces, while in the EU, electric arc furnace share is only 40%. Turkish steel industry has been suffering from increasing protectionist measures for some time. On this slide, you may see the measures that are imposed in 2021 and have a direct impact on Turkey's steel industry. Russia raised export tax for ferrous scrap twice this year. Malaysia has imposed a 15% export duty on scrap. The Eurasian Economic Union has published a draft board decision on the inclusion of ferrous scrap in the list of goods of which a ban on export exists outside the member states, Russia, Armenia, Belarus, Kazakhstan, and Kyrgyzstan. Meanwhile, Russia has not yet introduced a complete ban on the export of ferrous scrap, limiting itself to increase the minimum fiscal value of ferrous scrap export duty to 70 euros. The European Commission is considering changes to European waste management shipment regulations that could prove to be tremendous importance and potentially highly damaging to ferrous scrap export flows. In early June this year, the ITC determined that revoking the existing anti-dumping and countervailing duties on South Korea and Turkish origin welded pipe imports would lead to injury, and existing orders will remain in place. The US Department of Commerce has announced the final results of an anti-dumping duty review on imports of rebar from Turkey, updating its margins for several Turkish rebar producers. On June 25, the European Commission has officially announced the opening of an anti-dumping investigation into imports of hot-dip galvanized coils from Turkey and Russia. And again, European Commission has decided to extend safeguard measures for a further 3 years beyond 30 June. The safeguard tax-free quotas are now set to be increased by 3% each year. The UK has extended safeguard measures on 16 steel products as well. Although the Trade Remedies Authority has recommended revocation of measures on 9 products, including merchant bars and wire rod, the government has decided to extend the measures on these products for 1 more year. For the other 11 products, safeguard measures are extended for 3 years. The European Commission has issued the confirmation of definitive anti-dumping measures against European imports of Turkish hot-rolled coils. Duties have been slightly reduced from the provisional measures implemented in January and are effective as of July 5 this year. And after extending scrap export duty until September 2026, Ukraine's Metal Association has asked the country's prime minister to consider implementation of a temporary ferrous scrap export ban until the end of 2023. It's interesting that the letter states that in the climate when other major scrap exporters are all actively limiting or working on limiting their ferrous scrap exports, Ukraine becomes the most accessible source of scrap for importers, and in the pace of scrap export growth persists until the end of 2021, this could lead to a 9.5% fall in Ukraine's 2021 steel production and an almost 6.6% drop in steel exports. So before ending my presentation, we would like to see where you see the Turkish scrap prices by the end of August. Here comes a poll question.
Okay, so the poll question here is, where do you see the CFR Turkish scrap price, which is currently at $475 a ton? Where do you see that by the end of August 2021?
Oh, okay. So 37% of our attendees expect a slight decline in the prices, while 30% of our attendees expect stronger prices by the end of August. Only a few of our attendees expect dramatic declines or increases. Okay, thanks for your votes. Thank you. That was the end of my presentation. Thank you, Tom.
My pleasure. Thank you, Bershak. We'll move straight on in the interest of time. So next up, we have Katya Urakova, who is going to be covering CIS markets for us. Take it away, Katya.
Thank you, Tom. Good afternoon, ladies and gentlemen. We meet again with some of you. It's great to be here today. And in my short presentation today, I will try to very briefly cover the situation in the Black Sea export market. This month, it has been quite different. This month, we have seen a real shift in the dynamic. So there was quite a tangible bearish shift, despite supply's best effort to keep prices from softening. We'll talk about it in a minute. And none of the commodities which are traded in the Black Sea have escaped that shift. So most pronounced was the decline in HRC prices everywhere, save for Europe and the United States. But all that was due to pressure from Asian competition in the CIS key markets, such as Turkey, Middle East, North Africa, and Europe a little bit. So China continues to be watched by the world with its decision or not to implement export duties and its efforts to reduce the output, which everybody already said today is going to have a huge impact on the market, on the global market. But what has also been quite tangible in terms of effect on prices is Russian export duty, which has been confirmed in the end of June. And you can see here, this is where it happened, around here. So we can see that already descending trend has intensified. And although some of the some of the products started recovering, such as billet and hot rolled coil. Other products actually are still, prices of other products are still going down. On the positive note, lower prices, which were also caused, I mean, the HRC price decline was in the Black Sea market was also caused by major Russian producer releasing large quantities of HRC to the market. We don't know what exactly they are, but we're probably talking about a couple of 100,000 to Southeast Asia and North Africa and South America. That's happened in July, in order to release as much material before the duty becomes applicable, which sort of forced an already happening decline and forced other producers to also reduce their prices. But at the moment, as you can see, prices are trying to recover. So we're going to see what the actual duty, what the effect the actual duty is going to have from 1st of August, and we'll probably look at this in our next webinar, which will happen in several weeks, and we already have some tangible facts to play with. So this decline in prices in July, on a positive note, drew attention to buyers which were simply unable to purchase and restock at these prices, and also it kind of eased the pressure in terms of credit availability, although the freight issue continued to weigh on the market. So the positive effect of, for example, Middle East and North Africa returning to more inquiries for CIS material, especially HRC, it has been kind of nivelated by the fact that freights were rising. So trading as such was pretty limited unless you are a very large trader who can afford to trade larger volumes and has higher creditability. So coming back to what's going to happen possibly in August, it's difficult to forecast or predict whether Chinese export duty is going to be implemented from 1st of August, or whether it's going to be implemented on 1st of September, or whether it's going to be implemented at all. But it's also difficult to quantify how it's going to affect the prices. But Russia's first duty implementation is already affecting prices. Also, what is affecting prices of Russian and Ukrainian producers in the Black Sea market is a competition with Asian producers. We have seen a lot of Indian material available in CIS and Russia, key export markets, mainly Turkey, to some extent Europe, Middle East and Africa. And not to forget, there is also a restarting of MMK metallurgy in Turkey, which will add around 320,000 tons of HRC this year into the market. So this has affected the demand in Turkey already. My colleague Borchak hasn't really spoken about the prices of HRC, but we can see here from the highs of about 1,180 in the end of May, the prices have plateaued now at the level of about 1,100. That's offers, but maybe 1,030, 1,040, 1,050 ex-works. That's for October allocations, whilst imports from India, although rising in value, the offers are rising from offers and sales at 880, 885 CFR. Maybe a month ago, we now see offers have risen by about $100. So they're now 950, 980, and it depends on what sort of material we're looking at. But yet again, this is pressuring Black Sea supplies enormously. And if we're looking at lead times, for example, in spring or in the winter of this year, we were looking at lead times of 3 months. Now the lead times are shrinking as well. So Ukrainian suppliers have material, as far as we know, available for delivery in the end of September. Russian suppliers, some have material for the September, some have material for October delivery, and at prices of around 950 CFR for HRC. This means that all taxes added, import taxes in Turkey added and included, these prices are still below what Turkish producers are offering their HRC at. Which means there's a bit of a stalemate at the moment in buying, and everybody is looking to see what's going to happen on and after 1st of August. So as far as Russian HRC and CRC prices are concerned, the introduction of duties could significantly alter the Black, Baltic and Russian Far East export markets, as suppliers could redirect their sales to domestic market, causing oversupply and price declines there, and prices rising in the export market instead. So the scenario is applicable to all products, including semi-finished products, not just HRC, but especially to those products with lower margins, such as rebar and billet. We know that some Russian scrap-based mills already have high production costs, and they are saying that they might have to reduce their output unless they get scrap at much lower prices. So from about 26.5, 27,000 tons, the prices of scrap are now at around 25,000, 26,000 rubles. That is about $355, $350. Producers are saying that although prices of scrap are coming down and they're managing to renegotiate them down, they're not coming down fast enough. So, and similar situation has been recorded in semi-finished and raw materials export markets. That here we can see billet and pig iron price dynamic. Again, when the introduction of duty happened and has been confirmed, I'm talking about Russian ferrous export duty, around here we can see quite significant price fall, despite of what producers were saying to the government that the prices will go up. But as you can see, you know, billet is recovering somewhat, mainly on China's billet price rise in the last 3 weeks. I mean, now it's at about 725 CFR and expected to keep going up for the reasons which Tom already covered. A similar situation, yes, a similar situation is happening with slab as well and with pig iron. So talking about prices of slab, there is a notion that they will probably decrease most tangibly, mainly because they're pushed down by the prices of HRC, which have declined considerably, and already having lost about $130 in the last month from the highs of 950, 960. Well, it's not the last month, it's more like 2 months from the end of May. Now demand for slab is seen at 800, 840 FOB Black Sea, and largely depending on the destination and tonnages as freight continues to weigh on prices. So there is less opportunity to trade at higher prices. So lower levels, about 800, 820 FOB are workable in Turkey. Higher levels, about 830, 840 are workable in Europe. And although Latin America is also traditionally in the market for slab, Brazilian quota for the US is considerably low for the last quarter, for the fourth quarter. So there is an opinion in the market that there is a chance that Brazil will intensify its exports to the Eastern Hemisphere, including Mediterranean market, Turkey and Italy, which of course could result in more pressure on prices of slab. And of course, the Russian duty, which is $115 per ton, but no, well, it's 15%, but not less than $115 per ton, is another major factor weighing on price, especially for those mills that sell large volumes to their European and US re-rolling mills. Now, for the US re-rolling mills, for companies such as Evraz and NLMK, it is going to be a duty paid twice. It's going to be an export duty of 15%, but no less than $115 on exit, and there will be another duty of 25% on the entry to the US. Now, another interesting and quite pressuring situation has formed in the pig iron export market. In the last 3 months, there has been a tangible standoff between CIS suppliers and their main buyers, the US. So producers kept pushing prices up in line with US domestic flat product prices increases. But buyers in the US managed to make do with receiving earlier purchases, using more scrap, and sustaining on Brazilian and long-term contracts with CIS suppliers. We also know that several Indian intercompany purchases were made. So all of this contributed to sustained supply levels of pig iron and ongoing refusal by US mills to pay more than 650, 630 CFR New Orleans on average in July, which is quite bad news for Russian merchant pig iron producers. And yet again, considering new export duty, which has been reduced from $115 per ton as a minimal fiscal value to $54 per ton, it still weighs heavily on them. So let's imagine the price of $650 per ton CIF New Orleans cargo with around $40 freight plus costs, and this will net back to around $600 FOB Black Sea. Now, the $54 minimum fiscal duty becomes 15% after the FOB price level exceeds $415 per ton. So up to that point, 15% is paid on any price, meaning cargo sold at $600 FOB will incur a $78.79 per ton duty, which will net back to the producer at $522, just as an example. So needless to say, this duty is very much on hand, helpful for Ukrainian producers, as their exports are duty-free and the restrictions on their Russian counterparts are playing on hand. They enable possible increase in export volumes in case Russian suppliers withdraw some of the products in the export market as economically unviable. As I said earlier, there's possibility that there will be less billet and other products, and gives Ukrainian suppliers more flexibility in their pricing and in this enforced absence of competition. So lastly, positive news still, a couple of words about cost of production and how any price decrease would affect CIS steel producers. So you can see here, I've just taken these numbers at the bottom from the company's Q2 financial results, and we can see the cost of slab MMK not fully integrated, 391, Severstal 175, this is integrated cost, and LMK 252. So dollars per ton. So re-rolling, I added very roughly $150. I mean, all these numbers are approximate, and just for the demonstration of the strength and flexibility, which is ongoing for CIS producers despite the challenges, mainly Russian producers, despite the challenges which they're facing at the moment. So the price of cost price of HRC, you can see here, and this is the average price in the second quarter of HRC, FOB HRC price in the Black Sea market. And so as you can see, there is still quite good margin. The main thing is not to oversupply domestic market, which I think some of the orchestrators of the duty are quite counting on. Here we see billet cost of production, which shows very clearly that this is EAF-based mills. Approximately, this is price of scrap, this is the casting costs, and on the exit, this is an average price again for the last quarter. So we can see that adding $115 or 15% is going to eat into costs and not allow producers to make any profit. Now, this is integrated producers, approximate cost, vertically integrated producers of billet production. So we can see that even with the duty of $115 and 15%, and especially as China is stirring again into the importing, these are the producers who are going to be okay and who are going to be selling and exporting for a while, despite of the duty. So this is it for today. I'll be happy to answer any questions. Thank you for your attention. I'll pass the stage back to Tom. Thank you.
Thanks, Katya. Lots of great information there. In the interest of time, again, we'll skip straight on to the next presentation. So I'd like to invite Emanuela Nossa to give us an introduction on what's going on in Europe. Take it away, Emanuela.
Thank you, Tom. Thank you, everyone, for joining. I will be relatively quick. I know we are a little bit late with time. Well, I want to continue on what Tom in particular has highlighted at the beginning of the webinar, meaning what is happening, I mean, the differentials that are happening in different markets. Tom showed us how iron ore has actually corrected downwards, whereas finished steel price, in particular rebar in China, has not. And I want to show how European, and then I'm sure Dan after me, North American finished steel prices are actually holding up quite strongly, even though Asian pricing sentiment and Middle Eastern and CIS pricing sentiment has weakened during the last month and a half. So to start, I'm just going to show you what's happening with raw materials. On the raw materials front, Europe keeps following very closely what is happening in Turkey. So you can see the correlation between HMS prices in Turkey and HMS prices in Benelux, in Rotterdam. No differential, but if we move to finished steel prices, you see that this correlation is not there anymore. The green line is HRC prices in Northern Europe. As you can see, the trend has been following similar trends, let's say, for at least the last 2 years. And then since, well, a month and a half, more or less, Turkish prices, Chinese prices, and CIS prices have started correcting. They're now starting probably a new stabilization. But HRC prices in Europe, this is Northern Europe, but Southern Europe would be the same, have continued to rise and have reached new records. They are now starting to stabilize. There is a little bit of downward pressure in Italy, but prices are clearly continuing on a different trend compared with other HRC prices in other parts of the world further east. Same goes for rebar. This is rebar prices in Northern Europe and rebar prices Turkish FOB. You can see exactly the same thing happening. And again, this is an element that is expected to continue. What I want to look at in this presentation is why this is happening and why we expect this to continue at least for the short term. Let's see. Well, first of all, I know Dan will speak about it later, but the same is happening in North America. The difference is also that in North America, we already saw something similar happening back in 2018 when the Section 232 was implemented by the Trump administration. So it's not new, but of course the magnitude of what is happening in North America again, it's bigger now, and it's this time around it seems to be in line with what is happening in Europe, whereas back in 2018 Europe was following the trend of Chinese, Black Sea, and Turkish HRC prices, whereas North America saw a big increase because of the Section 232. So let's look at why this is the case. First reason remains safeguard quotas, as much as, of course, steelmakers in Europe play down a little bit the role of safeguard quotas in their impact on prices. We need to accept the fact that the impact is direct. You can see here safeguard quotas were confirmed, as you all know, starting from the 1st of July from a period of 3 more years. Here I showed you the allocation of tax-free quotas for Q3. Around 8.4 million tons of tax-free quotas were allocated for all of the products involved. Around a quarter has been already used, which is not much if you think about it, given in particular that most of the quotas are used during the first days because there are volumes that have been stopped at the docks waiting to be cleared. But if you look further down, you can see that the allocation has been concentrated mainly in a few products, very key products that have exhausted their quotas already. Indian HRC, as we all expected, Indian metallic coated sheet group 4A, meaning non-automotive, but also Turkish rebar, Turkish and Russian hollow section, and Turkish merchant bar. So some key products, Indian HRC is the case because all of the other HRC supplies face an anti-dumping. So they are one of the few without an anti-dumping. Turkish rebar is another example. So clearly the impact of safeguard quotas remains strong, and it's not the case, and it's not I mean, it's not, it was expected, let's say, that the acceleration of steel prices at the beginning of July as safeguard quotas were confirmed would have happened, and this happened. Another element which is more linked to what happened in the last few weeks, we all know that the European market has been suffering from supply tightness since at least end of Q3 and Q4 2020. As soon as demand started recovering from COVID, European steelmakers clearly showed a little bit of impossibility to supply the increasing demand. We were expecting this gap between demand and supply to be filled at least going into maybe September this year. But what happened, especially in Germany, but let's say Northwest Europe with the floods in the last few weeks, might delay a little bit of this recovery. The floods have forced some important supplier like ThyssenKrupp Steel to declare force majeure. Even on the long side, Badische Stahlwerk stopped production for a week or so, if I'm not wrong. Even LMK Group, a re-roller that's supplying coils in the Benelux area, declared force majeure, not for the flooding, but for a fire. So what is happening at mills actually seems to be confirming that the supply tightness in Europe will continue for longer than expected, meaning at least until the end of the year, maybe the beginning of next year as well. And this is, of course, a reason behind the fact that European steel prices do not seem to be looking down at the moment, even though the international sentiment has turned. Last but not least, of course, environmental reasons. We all know that the European Commission published the new Fit for 55 set of measures that will accelerate the cut of CO2 emissions within the European Commission. Within that, the steel market is massively impacted, mainly because of the decision to cut further carbon allocation for steel makers. So they will be cut by 4.2% annually, rather than the 2.2% annual cut that was currently in place. So free carbon allocation for steel makers will be less and will accelerate, therefore, the increase of cost of European ETS, of European free allocation for the market. As you can see, I put the chart down there. You can see that from 2012 until end of 2018, price of allocation for CO2 emissions were below the 20 euros per ton. They are now around 50-55 euros per ton. They should continue to increase. This is what Fitch says, and this is of course going to impact the prices, because steel makers will of course have to turn this higher costs to their end users, and this will keep prices elevated. Having said all that, what is interesting is that there is always anyway a possibility of a price downside going forward, mainly because as the steel prices remain that elevated in Europe, profits from steel makers are skyrocketing. We are in a phase where steel makers in Europe are publishing their Q2 results. Usually the first one to publish it is SSAB, and you can see here that SSAB in Q2 made a record operating profit, which was driven, of course, by strong demand, but mainly by high steel prices. Because as you can see in the results, then you can see that production was relatively stable. Volumes were not that much higher, but the reality is that they never recorded an operating profit this high, which was, as you can see here, 4 billion SEK, so a record level. So given this much profitability for steel makers, there is room for prices to move down a little bit, especially to support maybe the recovery in demand in the market. But at the moment, it doesn't seem to be the case. So we'll have to continue and monitor the market. I hand over to Dan, but I'm available for question on specific elements of my presentation. Thank you.
Thanks, Emanuele. And as you just said, last but not least, it's Dan Hilliard from the USA. I'll leave you to take over. Thanks.
Thank you, Tom. Very briefly, before we get to the question and answer session, I'm going to go over the state of the US steel market, titled The Summer That Wasn't. And without further ado, let's get into it. Flat rolled is still skyrocketing. US sheet prices are now hovering right around 1,800, maybe $20, $30 on either side of that for the last couple weeks. And that's a difficult price to get much end use done. 3 times the price of a healthy sheet market. Plate has been sort of slumming below the historical premium that it holds to hot rolled coil, but that's quickly changing. There's increases of $100 to $200 coming out of Nucor and SSAB, very quickly approaching the $1,600 short ton threshold. And why is this? Why is flat rolled so much higher in the United States than pretty much anywhere, and definitely compared to its historic averages? The US market has benefited or been affected by, depending on what side of the equation you're on, several black swan events in a row. You had COVID, and now you have the semiconductor shortage. This is the biggie for sheet. Auto demand is being drawn out throughout the year, just like it was last year with the COVID. The result is a near endless supply of base loading for the flat rolled mills. They don't really have to worry about where their next order is coming from. Therefore, just like a ratchet, it's easy to raise prices, come up to that level, raise again, and move up from there. I wanted to share this quote that we actually ran in our sister publication, Kallanish Power Materials, from Elon Musk, the techno king of Tesla. If we had everything else, if we had vast numbers of the vehicles themselves, we would not be able to make them. It is difficult for us to say how long this will last. This is out of our control, essentially. It does seem like it's getting better, but it's hard to predict. Tesla, even though it's an electric vehicle maker, speaks for almost all automakers when it says that the semiconductor shortage is the main limiting factor for auto right now, which makes it the main limiting factor for sheet. As long as that semiconductor situation stays fluid, I would expect sheet to remain elevated. Moving on from the flat rolled arena, I want to talk very briefly about construction and infrastructure, which means longs. President Biden is still pushing an infrastructure bill through Congress. There's a lot of debate right now about whether it's going to be top down or bottom up. Traditionally, Democratic administrations go for the top down. That's good news for steel. Top down means public investment in big money projects that municipalities usually can't afford on their own. That would be, bridges, ports, massive projects that consume a lot of rebar, beam, wire rod, plate. Private investment is still a part of it, as there is significant Republican pushback against the infrastructure bill. Private investment is less steel intensive. It usually ends up in some kind of road paving project. So good things ahead for longs, but more organically good as opposed to the black swan events that are moving through flat roll. And everybody's favorite topic, the 232, the Section 232. President Biden has still not come out one way or another on the fate of the 232, but there's enough details around the edges of what he's saying to paint sort of a picture of what we might expect. Just to lay some background, Democratic administrations, in addition to the top-down infrastructure approach, are typically tariff heavy. That caters to their union base. They're more protectionist in general. Biden has signaled that he wants a kinder, gentler approach as opposed to President Trump's blanket Section 232 on the entire world. This will likely take the form of additional deals with the EU, which we've already seen announced, and a friendly click against China rather than a hostile barrier. But a barrier it remains, because China is still the boogeyman of the US steel industry at the highest levels. It's easy enough to round up quotes from Biden and other top officials that specifically point to China being the biggest threat to the US steel industry. Whether that's true or not is sort of debatable, but from a policy standpoint, that's what they're looking at. Down on the ground on the market sources tell me they're not quite worried. Even if the 232 officially goes away, and it might look good for Biden to do away with one of President Trump's lingering shadows on his administration, one of his successes that can be pointed to. Even if the 232 officially goes away, the U.S. has a lot of other tools in its toolkit. There are traditional trade cases, which there are many. There's also something called the 201. The 232 says we can't import steel because we're protecting our national security. It's kind of like a universal ban hammer. The 201 says we can't import because we need to protect our domestic industry. It's a slight shift in focus, but it accomplishes much the same thing. So on the trade front, I would expect Biden to hold the rhetoric line, even if the words in that line get rearranged a little bit. At this point, I know I'm going a little bit quickly. I want to get to the Q&A and get all your questions. I would like to call for the poll, and I want to see your opinion on what steel prices might do in the medium term.
Okay, so our final poll question is, when will US sheet prices begin to decline?
Okay, thank you for that. It looks like the vast majority of you expect that this year will be steady state with a change coming in Q1 2022. I don't have an argument one way or another against that, but I would ask you to, possibly tell us either, in a market-to-market basis or maybe during the Q&A, why do you think that the market will change in Q1 2022? What will fundamentally change? We should expect to see scrap and iron ore prices remain elevated due to winter weather. We'll be past the holiday season, and Q1 is traditionally when prices recover. So it's interesting, but I couldn't say one way or the other, truly. So just to wrap up and speed us along to the actual question and answer session, wanted to just go ahead and do a quick roundup. All right, so what's next? Unprecedented market conditions continue to prevail, and it looks like that's going to be the case till at least Q1, according to your own observations. We're not likely to see any sort of significant summer slowdown. Prices remain well above any kind of historical average. The summer slowdown is usually a factor of, well, at least for sheet, auto. And as we've seen, auto demand is slow and steady due to the semiconductor shortage, which is good news for steel. Absent some kind of new black swan event, steady state is expected till at least the holiday season, and I don't believe that the holiday season is going to have the impact it has in years past. If anything, it will just exacerbate the squeeze currently going on. Very briefly, the steel capacity that was slated to come online in 2020 to 2022, that is still coming, but the market seems much better able to absorb it after COVID. Capacity was lost to COVID. There was also a good deal of consolidation. The largest flat roll producer in North America, which is Cleveland-Cliffs, says it values quality over quantity when it comes to tonnage. There might be a sense of discipline that emerged from COVID that we didn't quite see before. Just last but not least, keep an eye on green steel, decarbonization, and the continued electrification of auto, again, via our sister publication, Kallanish Power Materials. Big changes are likely to come from that sector that will have wide-reaching reverberations for steel, and we'll see you in the future. I'll pass you back to Tom for the Q&A.
Thanks, Dan. We'll move on to the Q&A, so if you can all come back. And thank you also for your presentations. Also, thank you to the audience who have been very, very active. In fact, so active that if I just read out all of your questions, we'd run out of time. So what we're going to do is we'll try and get through as many of these as we can live, but there will be some that we don't get around to, I'll warn you now, and we will try and provide written responses to those after the webinar. I'd like to kick things off slightly where Dan left off. There's a lot of talk environmentally in terms of policies coming in various regions around the world. One that we've got a lot of questions on, this is for you, Emanuela, is the border adjustment mechanism. So two kind of combined questions. One is, what is the impact going to be for people trying to sell steel into Europe? And the second question is it compliant with WTO rules?
Okay, so I think it's a good question to start off, because everyone has been trying to understand what goes on with the carbon border adjustment. I think the straight answer is that what is important at this stage is that the European Commission confirmed the intention to put in place a carbon border adjustment. But the reality of how this will impact the steel market is still yet to be decided in a way, for two reasons. First of all, the carbon border adjustment only becomes effective from 2026, meaning we have 5 more years of a lot of things happening. And first of all, don't forget that the announcement of the carbon border adjustment has been made by the European Commission, mainly, I mean, policy-wise, the idea is if we announce the carbon border adjustment early, the other parts of the world will implement their own policies to reduce CO2 emissions, and therefore, eventually, most of our trade partners, commercial trade partners, will not be affected by this adjustment. So at this stage, we cannot say, we know that there will be one, and we know it's going to impact steel. This is confirmed, but we don't know, A, if other parts of the world will implement drastic CO2 emission reduction, which will therefore limit the impact that they will have to pay, because the way it works is you will have to pay for the differential of CO2 emissions that you have not offset by paying, for example, in Europe, using the emission trading system, so the allowances. So we don't know. We don't know if other parts of the world will implement this. And second of all, we also don't know yet which products will be included. So the steel products will be included, but for example, if you look at the first proposal, I think there is a new one that includes more products. But in the first proposal, stainless steel was not included, tubes were not included, special steels were not included. They were all under review in a way. So the straight answer is we need to wait and see. The only thing important is that it seems like the European Commission has wanted to send a message to its trade partners saying, put in place a way to offset CO2 emissions from your industry. If you do, then you will not be affected. But if by 2026 you don't, there will be a system for you to, well, for people importing products from outside of Europe to offset it.
It's interesting that you put it that way, and that you know, obviously from my side, I view the Chinese response to it, and they obviously see it very differently. But it's interesting that implicate in the beginning of it in 2026. You know, by that point, you know, China already now has a carbon trading system. Steel is probably going to be included in that from next year. So by 2025. It already has targets for carbon emissions from the steel industry to have peaked, and you know, steel will be paying for carbon credits, and it will have options to purchase more credits if necessary. It's interesting to see how other countries will catch up to that. But then, of course, for China, it doesn't actually sell a lot of steel into Europe, so maybe directly it's not the most obvious one. Katya, I wonder, you know, in Russia, you know, we've also seen, you know, over the year announcements of environmental investments, you know, primarily with existing technologies, you know, not necessarily the breakthrough technologies, but I wonder how you think that the implications would play out for Russian exporters or CIS exporters into Europe.
Thank you, Tom. It's hard to say right now, of course, for sure, but on paper, it's looking really good. First of all, because some producers, such as NLMK, already have assets in Europe, and they have been on the case for quite a few years. They take part in discussions, so they're pretty much on the case. Other producers are all, especially in the last set of results presentation, have announced the new plans and new targets, much higher targets. They're sticking to the targets which have been, unfortunately, I don't have the figures now on me, but I can certainly provide them for whoever would like. So on paper, it looks really good. Russia has a huge energy heritage, of course, and they have resources. They have money to invest into cleaner, more environmentally friendly production. So from what we have seen just this month, it looks like Russia is pretty confident that it will comply with whatever European Commission present next year.
Interesting. So
I want to add that Ukraine is also on the case and has just announced, the Metinvest has just announced a massive decarbonization program, and as a country as a whole, they're also pretty much on the case there too.
Okay. Dan, in the US, obviously, you know, the environment is one of these issues that Biden's spoken about quite a lot. How clear is it what policy implications could be there for the steel industry?
For steel specifically, there hasn't been many top-down directives. We've seen a lot of talk about using renewables. We've seen a lot of talk about using hydrogen or natural gas, but there haven't been many boons or threats from the federal government in that direction. They're sort of hoping that the steel industry cleans itself up on its own, is my guess. Long term, I think you might see a carbon marketplace develop, a much more developed carbon marketplace, and the steelmakers that don't invest to clean themselves up internally, which I should note is most of them. Almost all of the major mills have announced some kind of net zero by 2050 scheme. But I would expect for those that don't, they would participate in a carbon offset marketplace.
Yeah, it seems like investment's going to be quite significant globally. Just a brief update on that before I move to you, Bertrand, is we have seen some reports now coming out from CISA in China that they have a new draft plan on how to achieve carbon neutrality. They haven't made it public yet, but the figures that we kind of have so far are that there's going to be around 20 trillion renminbi in investment in the steel industry, which is essentially $3 trillion out to 2060, which is around $75 billion a year in carbon technologies sustained over 40 years. So a lot of money going into it, but obviously it's also a sign of just how much money is really needed, because there's a lot of investment to be had. Bertrand, I wonder what you think specifically about the border adjustment mechanism. I mean, Turkey in a way is actually one of the greenest steel industries in that it's very EAF heavy, and even the electricity is fairly green. There's a good amount of hydro, but obviously it's an important supplier of steel to Europe and to other regions. And I wonder what you think about the border adjustment mechanism. What you're hearing from traders and producers.
I will talk on behalf of Turkish producers now. They find this mechanism unfair, and they think this is a way of protectionism, because Turkey is already producing greener steel. As I told during my presentation, this is given that the 70% of Turkish steel production is coming out of blast electric arc furnaces. This gives Turkey a big advantage, of course. And Turkish steel industry does not find zero carbon target achievable, actually. Of course, they are already investing in some environmental measures. They are paying taxes. You know, the Turkish producers are not receiving subsidies from the government. Instead, they are paying taxes for it, for environmental issues. The electric arc furnace production gives, of course, advantage for Turkish mills, but such a mechanism, they think it's a kind of protectionism.
That's certainly the view of mills in China and a lot of Asia as well. There's perhaps the added complication that even if it was challenged in the WTO, there's nobody on the appellate body at WTO to actually make a ruling. So maybe it doesn't even matter if rules aren't followed anymore. Who knows? We have a couple of questions as well about the relative strength of long and flat products globally. So I wonder if we could all just kind of summarize that for our regions. Again, I'll start with you, Emanuele. The relative strength, outlook for the next year or so, long products versus flat products, which end user sectors are strongest, which are weakest?
Well, that's a good question. In terms of prices, I think both are, as I showed in my presentation, will be supported quite well by the current situation of Europe with the supply tightness. Demand is relatively strong. Imports will continue to be relatively difficult because of the safeguard, the new investigation, and so forth. In terms of demand-wise, definitely the construction sector is in a good position. We all know that the European countries are investing heavily in the next few years. They will be investing heavily, supported by the European Commission. This will, of course, fall down to big investment in infrastructure, and this is the case for all of the European countries. They will be given big allowances to invest in infrastructure. So definitely the construction sector is looking very good. On the flat side, the problem, as Dan said, remains the uncertainty of chip supplies and production levels for the automotive sector, for example. If this is solved, the demand starts to being there. I mean, the recovery of the automotive sector has been slower than the construction sector, but demand can be there. The problem is how much can really automotive producers produce in Europe in the next year. So definitely, if I was to give a straight answer, I would say the construction sector is looking better at the moment. It's strong in the medium term, very good outlook. But again, I think oil prices in Europe will be sustained by the fact that there is just no supply. The supply is just not enough to support the demand at the moment, and the current market, the way the market has organized itself, seems to be indicating that prices will remain elevated.
Okay. Dan, you spoke about this briefly in your presentation, but in terms of that balance, how do you see that playing out over the next year?
Flats will remain big time strong as the auto electrification trend continues. Longs should be supported by an infrastructure bill, but they won't see the kind of spike that you saw in flat roll. At best, it would be a steady draw of demand as new bridges and things like that are built, but nowhere near the kind of perfect storm that flat rolled experienced. So I would expect flat roll to remain at a premium to longs for the foreseeable future.
Burchak, Turkey is maybe in a slightly different situation, and domestically it's flat product markets. It's an important consumer, but there's issues with the Turkish economy. I wonder how you think flat versus longs demand in Turkey and for its export partners will play out over the next year. I think you're muted. Sorry, I can't hear you.
Yeah, okay, thank you. Turkish longs is very dependent on exports. So Turkish long steel producers are now expecting Asian demand actually. Once, we know that China will not be exporting too much steel in the near term. and instead they will be importing. So Turkish mills are focused on the news that will come out of China regarding the export tax and Asian demand to resume. But on the other hand, you know, the COVID-19 situation in Asia is also preventing demand from recovery. So on the long steel side, we have started exporting to the US as the prices are, you know, at historical high levels in the US, despite the anti-dumping duties and Section 232 duty. So I think we will continue to export to the US market, but the tonnages from the inquiries from Asia must come. At the moment, Turkish mills have long lead times. They are actually fully utilized until the end of September. So they are not in rush to decrease their prices. They are trying to keep their scrap rebar margins, but you know they have sufficient margins there. I mean, they may decrease those margins once lead times get lower. On the flat side, I think Katya can explain more about flats markets.
Yeah, why don't you go ahead, Katya, talk about the flats markets.
So Turkish situation, as we know, that Turkish consumption is higher than Turkish production of flats. That's why it's such a big importer. And Turkish producers have been enjoying incredible margins in the last, well, in the last year, definitely. And so far, so good. They are, of course, constrained with safeguard measures from certain countries. They cannot export as much as they used to. I'm talking about European Union. But on the whole, the industry is looking rather balanced. However, in the next 2 or 3 years, there will be extra capacities coming online. We already know that MMK Metallurgy is planning to produce, I think it's just over 2 million tons a year next year. So they'll planning to work at full capacity. You know, other mills are adding capacity. I think all in all, it's about 5 million tons in the next 2-3 years. So that is, in theory, going to level out the supply and demand. So Turkey will become practically self-sufficient. But that won't happen next year, although next year we will have metallurgy coming online. Turkish market of flat products is very tightly connected with Russia and CIS. They're one of the largest suppliers. I mean, India has been very active in the last several months, but there is no expectation that it will remain in the market, of course, because post-COVID pandemic, which India is still going through and Asia will join, you know, the demand is going to be, or expected to be, so high that it will become an importer even. So that is fine. Now, CIS domestic market, Russian domestic market, is actually very strong at the moment. There is a huge infrastructure spending planned until 2027. The companies are reprofiling. I mean, I'm talking about suppliers of steel, producers of steel, reprofiling to supply more steel, which is needed. So they work very tightly with the state, with the government. So it actually looks really tight and strong. So it's about 30% which is exported, 60% consumed at home. And it's the labor of love of the last, 20 years. So they have had a hard road going to the stage of the industry which they have now. So unless that changes and something drastic happens, then Russia in particular will remain domestically orientated steel producing country. And next year looks really good for Russia in terms of domestic prices and demand.
Interesting. I'll just jump in and bring in a little bit of Asia. Asia's really split into kind of 3 key regions on this. I mean, China, in a sense, sounds a little bit like Russia in the sense that it's becoming very domestically focused, cutting off exports. In terms of longs versus flats, there's an interesting trend, which is, automotive is recovering from, it had a pretty bad year, not just last year, but the year before last, it was already quite bad, but that's recovering. Long products, construction demand is under a little bit of pressure. There's kind of two key themes. One is real estate developers are under a lot of financial pressure right now. If you look at real estate prices, they're starting to cut prices in order to sell volumes, and that's starting to impact investment levels. And the other thing is that local government finances are being controlled increasingly by central government, and that's reducing the amount of funding that's going into infrastructure projects and other kind of local government building projects. So there's a definite advantage for flat products in China. In Southeast Asia, it should be going in the other direction. It hasn't been going in the other direction this year because the region had expected to be getting over COVID. It had expected to be funding a lot of infrastructure projects, and longs demand was expected to be very strong. The new rounds of COVID this year have really kind of delayed that. But the expectation is still that once Southeast Asia does get out of its severe outbreaks of COVID, government spending on infrastructure is going to be pushing longs demand. And then the last kind of key Asian area, which we haven't really spoken about much, but you brought up there, Katja, is India. And as you say, this year, COVID has dominated. The recovery from COVID is going to mean domestic demand is very strong. But then there's also this longer term picture. That India is kind of in that position where China was, in the early 2000s when it was starting to become a net exporter. And, over time, as capacity keeps ramping up, in 5-10 years time, that Indian material is going to be there as a regular export volume rather than the periodic export volumes that we see now and, in the next year or two, probably. We are already 18 minutes over our scheduled time, so I'm afraid we're going to have to call it a day there. There are still many questions which we haven't had a chance to get around to, so we will be trying to round those up, and everybody who's signed up for the webinar will get some responses to those questions. A reminder also that you will be able to rewatch the webinar eventually once it gets onto YouTube, which should be in a day or so, we hope. And finally, also a reminder that we are still running conferences, and we will soon be launching our new flat products conference for later in this year. Keep an eye out for emails about that, and we will be giving you more details shortly. We'll leave it there. So thank you, Dan, Berchak, Emanuela, Katja, and thank you to all of you for listening in, and we'll see you next time. All the best.